Hi everyone, welcome back. Here's a quick question for you. When you put money into a bank deposit, are you really scaling up your wealth? After all, the bank pays you interest, right? Sounds like a scalable asset. Just set it and forget it. But what if I told you that this might not be the whole story? Today we are going to peel back the layers and see whether your hard earned savings are actually building your financial flywheel or just jogging on a treadmill that never moves forward. Let's break it down. Okay, for us to understand the banking system, we need to look at the evolution of money. For us to understand the evolution of money, we all need to know how the story began, and that is gold. How gold became money and then didn't. Once upon a time, long before credit cards, bank apps, or even paper money, people traded things: grains for goods, salt for cloth. It was called barter, and it did work until it didn't. Imagine trading your sandwich for a phone. What if the other person doesn't like sandwiches? That's when humans realized that they needed something everyone valued. Enter gold. It was the shiny, rare, and never rusted element. People everywhere loved it. Kings hoarded it, traders weighed it, and it became a global language of trust. For centuries, gold was money. Simple. But carrying gold wasn't exactly convenient. So merchants and banks began issuing gold certificates. Paper notes that said, hey, I owe you this much gold, you can come and get it anytime. This paper was easier to carry and people trusted it implicitly because it was backed by real gold. Then came the central banks, kind of like the referees of the money game, and they controlled how much paper money was printed. And they claimed that it was supposedly backed by gold reserves. This gave economic stability and let nations trade wide and with trust. But everything changed after World War II. The US had the most gold, the strongest economy, and in 1944, at the Bretton Woods Conference, the world agreed, let's use the US dollar as the global reserve currency, which is going to be backed by gold. So every country's currency was linked to the dollar, and the dollar was in turn linked to gold. Then enters Keynesian economics, named after the genius John Maynard Keynes. He said, governments should not just sit around in a crisis. They should spend and boost the economy, invest in infrastructure, and save when times are good, but to spend when more governments needed more money. And that had a problem because gold had a limit. So these central banks suddenly wanted to print more currency, which was these promissory notes backed by gold, than was available as gold. So by 1971, President Richard Nixon faced a big problem. The US had printed more money, which were dollars, than it had gold to back them up. Countries started asking for their gold back. So Nixon went on TV and basically said, well, we are temporarily suspending the gold standard. The spoiler alert, it was never temporary. Since then, we have been in a world of fiat money, currency that has value because we believe it does, not because it's backed by anything physical. Today, banks create money, governments spend it, and central banks, they just adjust the levers, and we swipe, tap, and click without ever touching cash. But it all started with a shiny little rock called gold. So here's the classic belief: if I leave money in the bank, I earn interest. That's income, so it must be good. If I take a loan, I have to pay interest. That's money going out, so it must be bad. Seems rather straightforward, right? Save equal to asset, loan equal to liability, case closed. Well, not so fast. When you put money into a bank as a deposit, it's not just sitting on a locker with your name on it. You are actually giving a loan to the bank, and in return, the bank gives you a tiny interest rate. Sounds simple, right? But here's where it gets clever or crazier depending on how you look at it. Thanks to something called as a fractional reserve banking, the bank doesn't need to keep all your money in the vault. In fact, only need to hold a very small fraction, like say 10% or even less. The rest, they are allowed to loan it out. And not just once. They can loan out multiples of the money they actually have. So here's the cycle. You deposit say $1,000. Bank keeps say $100 in reserve. It loans out a $900. That $900 goes to someone else's bank account, and now the bank can repeat the process. Multiply this several times, and it is like your $1,000 because of loaning has now created $9,000 of new money floating around. This is how money is created in today's system. Not printed by the government, but multiplied by loans through banks. Okay, now let's talk about profit. The first slide you saw so many extravagant banks, so beautiful, wonderful architecture, and the brand image itself is quite famous. Banks charge a higher interest rate on loans. That's what they pay you for deposits. And so when they say give you say 3%, they might actually charge 9% or more for loans. And the loan amount is also scaled up several times. So even better for them. Now that explains how they own such costly infrastructure. Most loans are also secured by collateral. A house, a car, a business. So the risk is actually low on the part of the bank and returns are high. The spread, the difference between what they pay you and what they earn from others is what makes the bank incredibly profitable. But here's the kicker. The more loans created, the more money enters circulation. That sounds like growth, right? But inflation enters the chat. More money chasing the same amount of goods means prices go up. Your money buys less. And remember that tiny interest the bank pays you? Yeah, it's usually less than inflation, which means your savings are actually losing value over time. This is by design because most central banks set low interest rates to encourage borrowing, not saving. They want the economy to move, to grow, to consume. So please ask yourself this question. Am I building wealth by saving or just letting it slowly erode? Inflation is like a silent thief. You don't hear it, you don't see it, but it slowly erodes your money's power. Sure, banks pay you interest when you deposit your money, but here's the trick. The returns you get are usually less than the real inflation rate. So even though your account balance is growing, your actual purchasing power is shrinking. So, as a person, as an individual, what can you do? Take those regular returns and convert them into scalable assets, stocks, ETFs, income producing tools, or better yet, invest in yourself, learn skills, build something, design systems that grow with time. The person who takes loan to build a business can buy equipment or scale a product. That person or that enterprise turn a borrowed dollar into multiple dollars. That's leverage, and then he or she pays them back. But let us say someone borrows money for a luxury car or a vacation. That's a liability. Wearing a nice suit is a small term affair. So here's the kicker. Savers lose if they leave money idle. Loan takers lose if they use it for stuff that doesn't grow. But the person who learns to convert money into assets wins in the long run. Hence, it is said that saving money is like putting water into a leaky bucket, and it takes compounding and knowledge and experience to convert it into a flywheel kind of a system. So, wishing you all good luck in your journeys. And I hope in this small video, a big picture is being communicated so that we all leave this slide with an understanding that just keeping money idle in a savings bank account or even a fixed bank account is not going to make us an asset out of it, but rather an unseen liability. Thank you for your time and good luck in converting all the liabilities into assets. Thank you.